And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Tuesday edition of The Real Investment Show. I'm your host, Lance Roberts. Of course, yesterday, markets, were looking pretty good, on Monday. Everything was, kind of coming into the day yesterday, coming off a nice big kind of Friday rally, so to speak. Markets had recovered a lot of that initial loss, gotten back above the 200-day moving average. We talked about that yesterday. The one thing that continues to kind of elude the bulls, so to speak, so far is that, they keep getting all excited here. Every time we kind of get down to these lows, and we talked about this about 6-7 weeks ago, down towards these bottoms, we said, look, everybody's so bearish, you're going to have a rally in the markets. And then we start getting a rally based on this idea that the Fed is going to pivot, right? So we get a little bit of data that comes in, shows a little bit weaker CPI, a little bit less inflation. Get a report that comes in, maybe shows a little bit, weaker job growth or whatever than expected. Markets are rallying on that news. Every little bit of news to help support this idea that the Fed's going to pivot or pause. But the Fed has been very clear that that is not going to be the case. They are not going to pivot or pause anytime soon. Now, we talked about yesterday that, last week, Jerome Powell had come out and made the comments that, yes, they're going to slow the pace of rate hikes. Now, that was not new news, right? We knew the Fed was going to reduce their pace of rate hikes down to 50 basis points in December because it's just simply they can't keep hiking at 75. This is the most aggressive rate hiking campaign in 40 years. And every rate hiking campaign historically has led to either a recession, a bear market, or some type of crisis event, right? And so this is the most aggressive that we've had in 40 years. So expecting that we're going to have this soft landing in the economy or potentially no kind of, financial credit related event in the markets that cause a deeper downdraft in equities is a little bit naive. Because it's always happened, right? Now, this time could be different. I'm certainly not making the case that, we've got to absolutely have this kind of financial event, but historically, the track record for the Fed hiking rates has not been a good one. So it's interesting here is that every time the market starts to rally here, the market starts to immediately start to think about, they're going to pivot, they're going to pause. That's very different than slowing the pace of rate hikes. Slowing the pace of rate hikes means they're still hiking rates. And by the way, historically speaking, a 50 basis point hike is considered aggressive. 75 basis point rate hike, very aggressive, right? So they're still being very aggressive on rate hikes, even at 50 basis points, but they have to slow that pace at some point. They just can't keep doing it at 75. So markets kind of really mistook what Jerome Powell said last week. And I said last week that, it won't be surprising to see, some comments come out trying to knock the rally back down a bit because the Fed doesn't like these bullish rallies, especially they don't like these rallies where you mistake what they say, rally the market 3% in a day. Because that eases financial conditions. The one thing the Fed is trying to do, and we've talked about this numerous times before, is that the Fed is trying to tighten financial conditions. They want you to spend less money. They want you to stop spending money, going out shopping, doing all these things because they need to bring down inflation. The way that you do that is to slow economic growth. That's why they're saying, look, be aware, unemployment has to come up. We have to get wage growth down. We have to get prices down. We've got to get demand down. All that is very not beneficial for equity prices and not at this level with earnings still elevated, particularly estimates going into next year. But this is what the Fed's saying. And so we noted that, this easing of financial conditions by rallying the market was something the Fed wasn't going to like. And lo and behold, now, of course, on Friday after Jerome Powell had spoke last week. Friday was kind of the closeout of the month. And the Fed is now in blackout until next Wednesday, the 14th, when they have their next meeting. And that's going to be the meeting that they're going to hike rates by 50 basis points. So they're in blackout. So the only way the Fed can communicate right now with the markets and with the economy is through their Fed mouthpiece, Nick Timiraos, at the Wall Street Journal. And yesterday, we'll go over some of these comments this morning, but yesterday, Nick Timiraos wrote an article talking about the FOMC, and this is basically a leak from the Fed saying, look, we are going to keep hiking rates. We are going to remain on this battle to fight inflation. There is no pivot coming. And in fact, we may hike 50 basis points in February as well, not 25. So that much more aggressive kind of language coming out of the Federal Reserve knocked the markets down yesterday. Pretty decent sell-off, back below the 200-day moving average. Again, that downtrend line resistance that we have going all the way back to the beginning of this year really just continues to be a brick wall that the market cannot get above. And also, too, that failure yesterday back below the 200-day moving average, that negates that breakout above the 200-day moving average. So, again, we have another failed attempt like we had back in March of this year. Now, good news is, on a very short-term basis, markets have the 20-day and the 100-day moving average sitting just right below where prices are. We're back into that consolidation range that we've been in ever since really about 3 weeks ago. Markets really haven't gone much of anywhere. So we're kind of back into this area where we've got some decent support. But as we've been talking about, we said this yesterday, to use this rally here as a potential here, do your tax loss harvesting, do your, rebalance your risk, reduce your exposure to the markets. Markets are very overbought. And we're very close now to triggering this sell signal that's been a good sell signal all year long. Every time we get this kind of MACD sell signal that we've been talking about, it's been a good place to basically reduce your exposure to the markets and reduce that risk. And again, we'll get another opportunity. Now, when that opportunity comes, maybe a little bit later on in a couple of weeks, depends on what happens with the markets over the next few days. Futures are a little bit flat this morning. We'll see kind of what happens today. But again, don't be surprised. This market could just get stuck here for a little bit. But that still doesn't mean you shouldn't, rebalance that risk and reduce your risk to the markets, at least short term. Next year, we're going to have to deal with all these rate hikes. And again, as we'll talk about in a few minutes with some of the comments from the Fed yesterday, which, by the way, I also put those comments just for your edification in our daily market commentary. So if you go to our website right now, click on the daily market commentary banner or on the link on the front page, you can read today's daily market commentary. Also, if you subscribe to our email list right there at the same place, we'll deliver that morning commentary to you every morning. Keep you up to date about it's just a short read, maybe 2 minutes, 3-4 little bullet point topics, a bit of a market overview from a trading front, just to kind of keep you up to date, get you ready to go for the day's trading. But this morning, I posted out those comments from the Wall Street Journal, so we'll kind of review those this morning a little bit more, talk about what that means. Again, we're still getting this economic data coming in that, showing kind of a mixed bag. But the real issue here is that wage growth problem in the economy. That's the one thing the Fed is really focused on. A wage spiral is the one thing that they really don't want to have because of that inflationary impact into the overall economy. Anyway, lots of stuff to get into this morning, so stick around. We'll get into that right after the break. Be sure to get by the website, sign up for our daily market commentary. Don't forget to read and subscribe to our weekly newsletter that comes out every week. Has all of our stock screens in it and market analysis and more. It's a great read for the weekend. Keep you up to date on what's happening in the markets. We'll be right back after the break. RealInvestmentAdvice.com.
Get daily investment news you can use, delivered at the speed of the internet at relinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, relinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at relinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at relinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. relinvestmentadvice.com/retirement, relinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at relinvestmentadvice.com.
The Real Investment Show.
All right, welcome back to the show this morning. It is Tuesday as we roll through the month of December. It is rapidly approaching that being Christmas. So 71% of Americans say they have already finished their Christmas shopping. I am in the 29%. I'm actually in the 3% that haven't even started yet. So that'll probably happen like 2 days before Christmas.
And you accomplish this by physically going to the store.
Yeah, I just go to the store.
Glutton for punishment.
Well, no, basically just, I know what I want to get, so I just go get it.
Yep.
Come home. So
in and out, 15 minutes.
I believe in supporting small businesses as well. So, there's actually, it's funny. So I live in Houston. Brent and I live in Houston. And I know a lot of you listening to the radio go, I know you live in Houston. I'm listening to a Houston radio station. But, we do stream live on YouTube. So we have people listening all over the world. And we're very grateful to have you. But in Houston, it's a big city. There's 5 million people in the metroplex. Almost 6. Yeah. So,
third largest metro in the country.
Exactly. So, lots of people. So, but it's amazing every now and then you find these little things in Houston that are very small townish. Mm-hmm. Right. And I was a little bit, it was kind of funny because I was watching this movie yesterday and it reminded me of this. But there's this gas station where the attendant comes out, washes your windshield, checks your oil.
Where?
Fills up. There's actually a Conoco station at the corner of Willcrest and Memorial.
I'm there.
And they service your car just like the old days. They'll change your tires, change your fix your windshield, whatever you got, they'll fix it.
Really?
They pump your gas for you. So my wife likes to go because she hates pumping gas.
Right.
But and so now I they charge look, you pay a little bit more.
What is the upcharge per gallon?
It's not. It's
a quarter?
Maybe.
It's chump change.
Yeah, no, it is. But I now go there just to service small business because, here's a guy doing it, the old way. This is his only gas station. This is his business, right? And this is where we go back to, whenever we have high oil prices, everybody goes, well, just stop shopping at ExxonMobil, right? They don't own that, right? No. That's a franchisee that owns that station. That's your neighbor. That's that small business owner. So anyway, it just kind of fascinating because like right here in the middle of Houston is this kind of old style service. And I'm sure there's more out there. I'm sure that's not the only one. That's just the only one I've found.
The Conoco at Willcrest and Memorial.
And so I encourage you, if you're over that way, go patronage that business.
Yes.
Because that's the type of service you need in this country.
That's
anyway,
awesome.
Yeah, it's very cool. It's very cool. I totally got off on what I was talking about.
You were Christmas
shopping, yes.
You were
So-
buying gasoline for Christmas.
Yes, I'm buying gas for Christmas. No, but anyway, talking about supporting small businesses,
Yes.
and particularly in this economy, and because we have this invasion of mega corporations now, Apple, Google, Amazon, it makes it much harder for small businesses to compete. So they need your patronage. So that's why I still shop at stores. I could order from Amazon.
That's very cool.
Yeah,
But
yeah.
25 cents a gallon on a fill-up for me, that's
I don't-
$2.50 more than I'll pay.
I just found this like 3 weeks ago.
Yeah.
And so I've only filled up once, and I forgot to check what the upcharge was. So I got to go fill up with gas
We'll do
today or
some
tomorrow.
research.
So I'll get back with you and let
Yeah.
you know. But anyway, it's right across the street from that mega corporation, Starbucks. So anyway, so talk about just for the break, the Federal Reserve. They are in blackout. They can't talk right now. It's just like kind of anything else, right? They don't want to, it's interesting. We're in blackout. We don't want to move the markets, but hey, wink, wink, nudge, nudge. Let's call our buddy over at the Wall Street Journal and just, drop a hint. Well, and again, that's not the way it's written. It doesn't, the article doesn't say Jerome Powell stated. That's not what it says, right? This is Nick Timiraos writing in his own view. But you have to ask the question, well, where did you get that view from? Right? Because, and this is the most, one of those well-kept secrets that are not kept at all, right?
Yeah. Wink, wink, nudge, nudge.
Exactly. But Nick Timiraos and he's inherited this. There's always been kind of a Wall Street Journal journalist that has been, kind of gets a leak from the Federal Reserve, and this has gone on forever. Nick Timiraos is just the latest journalist to get this badge of honor, so to speak. Anyway, in the article that he wrote yesterday, and importantly, and like we've been saying, the market, the Fed does not like these market rallies because it basically undermines everything they're trying to do. They're trying to get people to be less optimistic. That's how you get inflation down, right? You've got to slow consumption. You've got to get people to stop spending money, stop going out, going crazy, doing stuff. You got to get them to clamp down a bit, and that's how you get inflation down. But that also slows economic growth. That also raises unemployment and brings wages down. And those are all the things that the Fed needs to accomplish and do that without potentially throwing the economy into a recession. That's the hard part, right? That's the magic formula. But anyway, in the Wall Street Journal yesterday, this is Nick. I'm going to quote from Nick Timiraos yesterday. Federal Reserve officials have signaled plans to raise their benchmark interest rate by 0.5 percentage point at their meeting next week. We already knew this, right? Nothing new in that story. But, see, there's the problem. We were good up to that point. Everything is in. Oh, we're going to slow the pace of rate hikes. That's awesome. That's why we've been rallying the markets, because the Fed's ready to pivot. But elevated wage pressures could lead them. Now, see how this is written? This isn't the Fed saying anything. This is just commentary by Nick Timiraos. This isn't the Fed saying anything. So they're still in blackout. Got to kind of read between the lines. Elevated wage pressures could lead them to continue lifting it to higher levels than investors currently expect. That was the line that sent the markets tumbling yesterday. Brisk wage growth or higher inflation in labor-intensive service sectors of the economy. Now, remember, we just got the services index out yesterday. It actually rose. So that's bullish, right? So, I mean, we're getting, we're still in expansion in terms of the services index. We're not below 50, and that index rose yesterday. The ISM services index actually rose yesterday. So brisk wage growth or higher inflation in labor-intensive service sectors of the economy could lead more of them, being the Fed officials, to support raising their benchmark rate next year above the 5% currently anticipated by investors. So going into the weekend, the market was predicting a decline in the terminal rate, which is the peak Fed funds rate, of less than 5%. We were about 4.75%. After this story hit the market yesterday, that terminal rate expected by Fed Fund futures is now above 5% again, right? So, and that's what basically this was saying, is that, we're going to hike rates until we solve this problem of inflation, and that could take us to a higher terminal rate than 5%. Now, Nick Timiraos went on to really confirm what a lot of the Fed speakers have been saying. It says, quote, they want to guard against raising rates too little and allowing inflation to resurge. So, in other words, what the Fed is concerned about is that they hike rates, inflation comes down a little bit, that's what we've seen, and then it takes off again. That was the problem of the 70s. Now, I think they're wrong. I think inflation is going to come down all by itself over the course of the next year, because that whole big pig in the python of monetary interventions that we stuck into the market has now worked its way mostly through the python. It's coming out the other side. By the way, did you happen to see that video of the python that swallowed the alligator?
I think I missed that one.
Yeah. It killed the python.
You think?
Because it just basically was too big, but it killed the alligator too. But it swallowed the alligator whole.
Mutually assured destruction.
Exactly. Just imagine how big that python was.
Where was this?
Probably down in
Florida.
the Amazon
Florida
somewhere.
man.
No, the Florida man.
His pets.
No, this is down in the Amazon somewhere. But that pig in the python, which has been moving through the system over the last year, all of this massive monetary interventions that we did, that $5 trillion worth of stimulus, is coming out the other side. And as those savings rates are plunging, we're going to see a contraction in other activity. So inflation's going to come down. The Fed's worried that it's going to resurge, but the only way it can resurge is if you have another massive round of monetary interventions. And that's not happening. So this is where I think the Fed makes a mistake. Now, I could be wrong, and happy to admit if I'm wrong, but this is where I think the Fed makes a mistake. I think they overhike in anticipation of getting this resurgence of inflation, and I think they're missing the mark of where that inflation originated from, because it wasn't organic. It wasn't an organic-based inflation like we saw in the 70s. Anyway, back to what Nick Timiraos said. They want to guard against raising rates too little and allowing inflation to resurge, or raising them too much and causing unnecessary economic weakness. And this is according to recent public comments and interviews. Well, you can't really have it both ways. And knowing exactly, because of the lag effect of monetary policy, knowing the exact point to stop so it's not too much and not too little is impossible. And that's why the risk is really to the downside in the markets of the Fed potentially overhiking rates. Be right back after the break. Got more to get into here.
Investment Advice blog. It's required reading for the informed investor. Catch it today at relinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I have the unfortunate situation of having Thanksgiving, Christmas, New Year's, Valentine's Day, and my wife's birthday is on December the 1st. So I get just smacked on spending. I save up all year just for this 3 months of the year.
The Real Investment Show podcast.
My wife has lots of problems. I tell her what her problems are all the time. I said, my problem with you, it's hard to buy for her because she's pretty much already bought what she wants.
At realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. You know, just listening to that promo for the show on the break, talking about me trying to buy for my wife because it's very problematic.
How'd you do?
Well, I mean, the problem is that, you know, after she married me, she had everything she wanted, right?
Especially, yes.
Yeah, I mean, so what else do you get her? I think she just needs to be grateful for me.
Yeah.
You know,
Jackpot, baby.
exactly. So she doesn't agree with that, by the way. She thinks it's the other way around.
Yeah.
But anyway.
So how did you do?
I haven't done yet.
You didn't get her anything for her birthday?
No. I told you the whole shopping trip.
Yeah.
Yeah. That was her birthday.
And how was it received?
She was there. She liked it fine.
Okay, good.
She picked everything out.
Trying to help you out here.
Right. Okay. There's one rule, by the way, gentlemen.
Yes.
There's a rule. There's a couple of things you do not buy your wife for Christmas. Russell, Cheryl, if you're listening to this show, pay attention.
Sage words.
Well, because there was another gentleman on the show that would buy his wife things like a vacuum cleaner.
Yes.
For her birthday or Christmas,
Not
or
good.
a cat litter box or something. You know, he was a practical gift giver.
Yeah.
Right. Couple of things you do not buy your wife for Christmas or birthdays: scales, workout wear, or workout equipment,
Or home appliances.
or well, no, but any of those three.
Yeah.
Workout wear, workout gear, or a scale. Do not buy those because it's immediately assumed that you think they're fat, right? So this is how you solve that problem. My wife needed workout wear. However, if I went and bought the workout wear, you run two big risks. First risk is you get the wrong size because you buy a large and she wears a medium. Now she's fat. Or you buy a small and she's a medium, and you bought this for your other girlfriend, right? So you must have got them confused. So there is the sizing issue. You better, if you're going to do it on your own, you better get it right and you better know it. The second thing is getting the right colors, the right textures, and all the other BS that goes along with workout gear. I mean, look, I buy Russell athletic wear from Academy, right? It's not, it's the stuff that's knockoff, like one leg is longer than the other type stuff, It's Nike with 3 Ks. It's on sale for $1.99. That's what I wear to the gym, right? And I wear it till one leg falls off and both legs are even, right? There you go. Anyway, so the way you get around this is you take your wife to the store and you let her pick out what she wants. This way, she's very happy. She has her workout gear. It was her idea. She says, hey, I need this. Great, babe. This is the way I did this. My wife says, I really need some new workout gear. Awesome. Let me take you to the store and we'll go get you some. And that's
Voila.
how this is how you solve a birthday and keep yourself out of trouble.
Very good.
And don't take your girlfriend to the same store. They all know each other. My wife walks into Athleta, and it's like walking into Cheers, right?
Right.
Like
Everybody
Norm!
knows your name.
It's like Christina. Nice to have you back. I was like, okay, now I know where your paycheck goes. Anyway,
By the way, did you see we lost Kirstie Alley?
we did. Speaking
Yeah.
of Cheers, 71 years old. She's been battling cancer for a while.
Yeah.
So, but yeah, she was
Talent.
I liked her.
Yeah.
She was
She was funny.
Yeah, she was. All right, so back to the story line here of the show. So just for the break, talking a little bit about the Fed kind of Wall Street Journal article, and this is really, I have an article out on the website today talking about this, that the bull case narrative has 2 issues to it. And ever since the kind of October lows, and again we go back to October. We were talking about then, everybody was bearish, right? All the headlines were the world's going to end and you better be in a bunker with, beanie weenies and ammo and extra gold, right? And then we have this massive rally. Now everybody's bullish. Right now everybody's on the other side of the camp going, well, this market's, the bottom's in, the bull market's back, it's all great, right? Fed's going to pivot. The problem with these bullish rallies is that they have 2 problems. And this is the article that's on the website today. It's called The Bull Case Has 2 Problems. And the 2 problems are the Fed and the Fed. It's no matter where you look. Either the problem is that the Fed is hiking rates, which is going to slow economic growth, which is going to taper earnings, right? That's going to reduce earnings, which means if earnings come down, valuations are going to go up unless prices come down as well. So that's an undermine of the bull case, right? Valuations are already elevated historically. And so if earnings come down and prices stay the same, valuations go up. But it's just math. So if earnings come down because of slower economic growth, slower economic activity, higher interest rates, prices have to come down as well. The other problem of the bull case is still the Fed with quantitative tightening. Over the last 12 years, there has been a cumulative total of almost $43 trillion injected into the economy, into the markets, either through Fed bailouts, government stimulus, quantitative easing programs. $42 trillion. It's $10 of monetary interventions for every dollar's worth of economic growth. The Fed is in the process of quantitative tightening. They're removing liquidity. All those monetary interventions, like we talked about, that's coming out of the market. That's not going into the market. That's all savings rates are back below pandemic levels now. Credit card rates the credit card levels, debt levels are rising. So that is going to be a headwind ultimately on consumption, which ultimately is lower earnings, which means that prices have to come down to justify lower earnings. So the problem of the bullish case is that you're still running into an environment with exceptionally high valuations. Now, does this mean that the markets can't have these bull cycles in it? Absolutely. But there is a challenge going forward until the Fed drops rates back to zero and until the Fed starts doing quantitative easing again. The bull case has a major headwind of the Fed and the Fed. And this is, the risk that we have to run, right? We talk about a lot on the show about probabilities and possibilities. And if we're going to have an earnings recession next year, yes, earnings have come down some, but they have not come down nearly enough to justify an economic recession. Now, assuming we can avoid a recession, which is possible, then earnings may have come down enough. Maybe earnings have come down enough. I still think that's unlikely, given the fact that that $5 trillion worth of stimulus that hit the market sent earnings through the roof, because you had a very anomalous situation where companies shut down and laid off a lot of employees, reducing that cost of labor. You had $5 trillion worth of liquidity come in that basically just blew profit margins through the roof. All of a sudden, I've got all this demand. I'm running skeleton crews to meet this demand. My profit margins go way up. But now I've had to hire all these people back as demand is starting to fall. So now my costs are coming up a lot more and my profit margins are going to shrink. So that ability to maintain earnings going forward, even just in a return to normality, is going to be very problematic. But then also you take a look at CEO confidence, which is at record lows. That historically does not bode well for employment going forward. We've talked a lot about layoffs coming from a lot of these big tech companies, right? And again, when you take a look at a lot of these tech companies during 2020, 2021, they were just hiring everybody. Just anybody that wanted a job basically got hired at a tech company. And they overhired. And so they've reduced their hiring now. We've talked about a lot of those layoffs. That's just basically getting rid of excess. They're kind of getting back to normal operating levels of employment. So that really isn't that recessionary. What we're looking for is when those layoffs start to spread over into other areas of the economy, like manufacturing and other services industries where the economy actually lives. PepsiCo to lay off hundreds after price hikes as consumer strength is now beginning question. So we're starting to see that. I suspect we're going to start to see more layoffs in kind of the broader macro economy as we get into the first part of next year, as the economy actually starts to slow down a good bit more. So we'll see, though. Again, this is all assumptions based on history. And we're looking back at history going, well, when the Fed has done this before, this is what has happened. When these indexes say this is what has happened. When the economic data says this is what has happened. Could this time be different? Absolutely. And you can't dismiss that. You can't dismiss that risk that this time is different for some reason that I haven't thought of, or we haven't thought of. All I'm saying is that right now, based on all the economic data, the risks certainly seem elevated that next year's economic growth could be substantially lower than what people currently expect because of two reasons: the Fed and the Fed. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at relinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, relinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at relinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at relinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. relinvestmentadvice.com/retirement, relinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at relinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Get ready to wrap things up. You know, about this time of the year, we start getting out all of these predictions for next year. All the analysts, Wall Street, et cetera, come out and say, well, we predict the market's going to be, 5,000 next year, whatever. And it was interesting because this time last year, that was what everybody was saying, right? Goldman Sachs, Morgan Stanley, et cetera, targets for the S&P 500 were 5,000 or better. Here we are at 4,000 right now. So, the problem with forecasts, predictions, et cetera, is they're generally wrong. Other things happen. And, but from a predictor standpoint, right? If I want to be a prediction expert, right? The best thing to do is always predict to the upside, because more often than not, you get a rising market. More often than not, it's just the bear markets really suck. But if you say, oh, market's going to be 4,500 next year and it gets to 4,400, hey, you were close enough, right? And nobody really cares when you're wrong, because all they remember is when you called it right. And it's just the way the markets work, and people want to be optimistic. And it's always interesting when I post stuff out on Twitter. I'll say, look, markets are a bit over exuberant right here, a little overbought, and immediately I get a bunch of comments. Well, I don't see any reason why the market's going to come down now, right? You just it's up from here. Everybody wants to be optimistic, right? Because hey, we like making money. We like when things go up because we always make money. Anyway, it always like the predictions because, again, it kind of gives you a good framework for, over optimism. Helps you kind of base your expectations for the next year. But every year, Saxo Bank comes out with their most outrageous predictions, and generally most of these never happen. But every once in a while, they'll nail one, and it's always kind of interesting when that happens. But here's a couple of the 10 outrageous predictions for 2023. The Billionaire Coalition creates a $1 trillion Manhattan Project for energy. It's the largest research and development effort since the original Manhattan Project that developed the first atomic bomb. Now, these are all predictions, right? This isn't really happening. The things I'm going to read to you from this list, those are predictions, and they're a lot of hyperbole and very outrageous. So just because I read this doesn't mean it's actually occurring. But it is interesting because, one of the things when, you talk about things like, critical race theory has been a big hot topic this year, with school boards, et cetera. And that comes out of Marxist teachings. And Klaus Schwab of the World Economic Forum, he's pushing this kind of Marxist idea into the world. He says, basically we need to kind of operate where corporations own everything. And basically you just kind of are subservient to the world corporations and the world elite. And the idea is that you really don't know much about yourself and you can't really take care of yourself. So the few wealthy elites and the governments of the world and the big corporations, they're going to, control everything. They'll have all the wealth. They'll live lives of luxury. You'll kind of scrap for what you need, but you'll rent everything you want and you'll be happy. That's the idea, right? It's all about power at the end of the day. But so these billionaires are going to get together, create $1 trillion Manhattan Project, and solve all of our energy problems. French President Macron will resign next year. In a televised address, he will criticize the opposition's standpoint of absolute blockage and announces he is retiring from politics. There's probably a few people that wouldn't be too upset about that. For you gold bugs, Saxo Bank says gold will rocket to $3,000 as central banks fail on their inflation mandate. Now, the only problem with that is that we've had 9% inflation this year at the peak and gold didn't rally. So, take it for what it's worth. The EU Army. That's all I need to say right there. Let's just move on to the next one. Actually, EU Army forces EU down a path to a full union. In 2023, it becomes clearer than ever that Europe needs to get the union's defensive posture in order. This is one of the interesting things about the European Union, if you didn't know this, is that the United States is a union, right? We're a monetary union, just kind of like the Eurozone. The difference is that we form this union of states. And if you kind of thought about the United States as for a second, like the European, like the EU, Texas is a country, Louisiana's, I don't know what you call Louisiana, but Mississippi, that's another problem. Florida is a country, California is a country. I'm joking. But each state is a country, right? We all came together as these individual countries and we said, okay, we're all going to operate under one currency, one central bank, et cetera. And we had a contract called the Constitution and Bill of Rights, et cetera, that tied all this together. So we created this monetary union under a central premise. The problem for the EU is they wanted to replicate this experiment that was very successful in the US by creating this monetary union in the EU. Where they failed and came up short was they never tied it all together with a constitutional contract. So they keep having all these problems. Brexit, etc. It's also the problem when you need to have a military, when you're not all operating under one kind of union. Everybody wants to have their own army, etc. Just imagine Texas has an army, Louisiana has an army, California has an army, Seattle has a bunch of baristas. So, got to have a central union. Anyway. Number 5, a country agrees to ban all meat production by 2030. So, didn't say which country, just a country. It plans to ban all domestically produced live animal source meat entirely by 2030. We'll see how that works out. Still think there's a lot of people that want to eat meat, not bugs, like the World Economic Forum wants you to do. UK holds un-Brexit referendum. Now, remember, we just talked about the fact in 2015, 2016, remember we went through the whole Brexit thing. The UK wanted to exit out of the EU. Now they want to potentially, this is the idea that in 2023, they'll go through an un-Brexit at Tiffany's. I wouldn't put a lot of weight on that one. Number 7, widespread price. Now, this one might actually be a reality. Widespread price controls are introduced to cap official inflation. There's, this is something that, back in 1947, following World War II, was a poll was put out because of inflation that was running back then. It's like, should we have price controls? And there was a very big support for price controls. And you've heard a lot about this year, as well. Capping the price of oil, capping the price of food, as an issue. And so the idea of price controls at the consumer level, when you go out to the voters and say, hey, would you like price controls? People kind of immediately go, yeah, if you can put, just cap oil prices at, $3 a gallon of gasoline, right? Whatever. That sounds great. Economically, it's a terrible idea. And you can only imagine what happens economically when you start trying to do price controls. It leads to a whole bevy of other economic outcomes. And nearly all wars in history have ultimately been fought over price controls because it doesn't work out well. Number 8, OPEC and Chindia. Or Chindia? I'm not. I think it's to be Chindia.
Chindia?
Chindia?
Yeah, Chindia.
Yeah, Chindia. Walk out of the IMF, agree to trade with a new reserve asset. Recognizing the ongoing weaponization of the U.S. dollar by the U.S. government, non-U.S. ally, which is interesting considering, when President Trump was in office, it was about China manipulating their currency. They were the currency manipulators. Now we're the currency manipulators. We've weaponized the dollar. According to Saxo Bank, non-U.S. allied countries moved to leave the USD and the IMF to create an international clearing union, ICU, with a new reserve asset. The bank core currency code will be KEY, K-E-Y. They will use Keynes' original idea from the pre-Bretton Woods days to thumb its nose at the practice of the U.S. and leveraging its power over the international monetary system. That's a really low probability event, like 0. USD... The USD Japanese yen fixed to the USD at 200 as Japan tries to finally overhaul their financial system. Of course, Japan on the verge of just complete bankruptcy at this point. Japan's real GDP will drop by over 8% when this occurs, according to Saxo. Again, prediction, not reality. Last one. Tax haven ban kills private equity. Probably would not be a bad idea. The OECD agrees in 2023 to move to a more aggressive stance on tax havens, launching a full ban on the largest tax havens in the world. Now, again, this is probably something that has I'm not sure it'll happen in 2023, but I suspect this is something that will happen down the road at some point is, a move to basically get rid of these tax havens because, again, with all the debt that is out there in the world right now that has to be serviced, where these tax havens are keeping tax dollars from getting to those in power that need those tax dollars, move to ban these tax havens or doing something different is certainly an interesting possibility. So that's the 10 outrageous, more or less, predictions of Saxo Bank for the year. Always interesting this time of year. Anyway, that wraps up the show. Have a great day. We'll be back here tomorrow. Stick around. 3 minutes on markets and money will be coming up shortly. Our latest blog post is out on the website talking about the bull case has 2 problems. And of course, if you have any questions or comments, be sure and send us an email. Always happy to help you out any way we can. realinvestmentadvice.com. Have a great day. See you back here tomorrow.